Good morning, ladies and gentlemen. We start this week with a wow and this chart, which I consider to be the takeaway from last week. As you know, if you've been following me for a while, I have drawn this years ago, 1627, 1950. Those are my trigger levels for volatility. This is a daily chart of the VIX. Anything below 1627 and we are in a bull market for equities. Anything between 1627 and 1950 we are in a probably retracement period, and anything over 1950 and we have a problem. We finished at 1731. We are far above the Bollinger Bands, but that doesn't really matter in volatility. And we do have a gap to fill here up towards 2170, which has been unfilled for best part of a year and a half. We will probably now go and fill that gap at some stage, but this is, to me, the most important chart from last week. Let's have a look at a weekly one as well. And here is the weekly VIX. I would now hope for several tests of the 1980 line, but I would also hope that the market closes within the 16 to 1980 area for several weeks and allows these technical Bollinger Bands and MAs to start turning higher. It is certainly a bad omen for the medium term, and something that we will try to explain now. Friday was one of those very rare days when all asset classes get dumped. Bonds got dumped, equities got dumped, commodities got dumped, gold got dumped. There was absolutely nowhere to hide but in cash. This move in bonds is now a third wave. We are definitely going higher in bonds, but we are probably going higher via a yield curve steepening, because people will be getting out of their risk parity trades. The risk parity trades are just enormous in size, and you just cannot stand in their way. However silly prices might get, they will get sillier simply because of the huge liquidity which is being added, or rather subtracted, from the risk parity trades. As you know, risk parity is when you buy 60-70% in equities, 40% in treasuries, and you also sell volatility on top of that. Well, those trades are now getting unwound, or being forced to be unwound. When that sort of happens, you're talking about tens of billions of equities and bonds and huge amounts of volatility which need to be unwound all at the same time, and that forces markets to trade to various opposite extremes to the ones we were trading at only a few days ago. This is going to be a very volatile market, both on the upside and the downside, and what you do in volatile markets is that you reduce leverage and look for bigger moves as opposed to concentrated positions. Let us try and put the move on Friday into context. It was patently obvious that the market could not keep on going up at the pace that it was going up, without some sort of retracement. This was the 2785 level that got busted on the upside in January through the top of the Bollinger Bands. And this is the level that will definitely trade at now, 27.25. I mean, I have absolutely zero doubt that during the course of February we trade 27.25. We probably trade quite a bit lower. Not because the market is entering any kind of a bear market. That is the important thing to realize. We are not going into a bear market now, because all the spreads that we follow are still very much in risk-on mode. Equity markets do not go into any kind of a bear market while those spreads are telling us that risk-on is prevalent. Not a single one of our risk spreads is telling us that this is anything but a bull market in equities. The question is just that it has to retrace. It's a normal bull market. It's not an abnormal bull market, and things are not different now. The market will not trade for long above the monthly Bollinger Band. It never has. It has always retraced, however far back in history you look, and that is what is happening here. Will it trade 27.25? Absolutely, probably even on Monday. But it's important to realize what part of the market you're in. You're now probably in a fourth wave, which will take at least 2 or 3 months of consolidation at lower levels before it pushes up higher. We are now in a classical trading market. You sell spikes, you buy ferocious dips. If we look at things from a weekly perspective, all that has happened here is that we are correcting the hugely overbought levels. I mean, we were at 90 on the RSI, we're now at 67. Let's hope that we go down towards 40 in the next few weeks and get the market nice and comfortable. This is distribution, this is risk parity trades being unwound. This is huge amounts of stock coming onto the market and being redistributed from weaker hands to and stop losses into stronger hands. We just need to find what levels make sense, and we can do that with a combination of monthly and weekly charts. As you saw, the first support on the monthlies is around the 27.25. That is bound to trade very quickly. If we now enlarge this chart, we will have a look at the first real support, which comes in on this trend line around 26.70, which is where we started the year. By the next couple of weeks, these moving averages, which are now at 26.40, will have probably come up towards the 26.70 area. All we will be doing is retesting these areas where we were 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 12 weeks ago. So we are basically looking for the middle of last quarter and those levels. Absolutely have very little doubt that we will be trading with a high of around 27.25 to 27.40 and a low of around 200 points lower, around the 26.50 area. So this should be the trading area for the next several weeks. If we go in even more to a daily, you will see that one of the rules of trading is that when the market busts through the upper Bollinger Bands, it tends to retrace to it and retest it from the downside. This is the level that we broke, 27.20, which was sometime last month. We now have these moving averages coming in at 27.24. we have 27.15 underneath, coupled with all those moving averages that we saw from the monthly. I would say that 27.15 to 27.25 in the next couple of days is almost a given, and that will be probably the area in which the market bounces and retests these moving averages on the top side, which will probably be just below 2800 by then. So if we do basically an A, a B, and then finally a C towards the mid 2650s or 2630s, that will be what we are looking for the next several weeks. When such dumping takes place, basically stop losses going off in the risk parity, it is a great opportunity to buy assets which are longer term, cheaper than and have more upside. You know our thoughts on NQ, because we really like XLK for the long term. We say XLK is America, and so we will be looking for the first level for XLK to get long is this conjugate here around 68.10 in 66.10 in NQ, followed by, you know, if we can bounce and move down towards the 200-day moving average, which at the moment is just over 6,000, but we have no doubt it'll be somewhere around here, around the 6,200, 6,300 level by the time we come and retest it. But those are going to be wonderful areas to get long on a spread basis against the rest of the market. We just love NQ for the longer term. We think if any market is going to make a rapid new high from this kind of pounding, it's going to be NQ much sooner than SPY. Well, the DAX is the one which is also very, very interesting because technically it is far ahead of SPY. We have a market which is now through the Bollinger Bands. It is touching the 200-day moving average and will probably open on Monday quite a bit lower, at least 100 lower, we think, from the latest prices, and will be touching probably the 61.8% retracement around the 12,600. We would argue that this market will definitely bounce up and trade 13, close to 13,000 again before going back down. And we are ultimately now looking for a test of this support line, which at the moment is around the 11,500, but by then will be 11,700, 11,800. We certainly think that the market takes out this low, or at least tests it. We will be buyers first thing on Monday if the open is very bad, because we know that the market will probably trade back up to at least the 200-day moving average, and there's a little bit of money to be made in it. But longer term, this is nowhere near a complete sequence. The complete sequence will probably be on a test of 11,600, 700, a nice bounce back up to the 200-day moving average, and then we see what happens, whether we break down or not. In any case, the takeaway from watching the European markets and the US markets is that the spreads are still telling us that the market is in a bull market. That means that either the spreads are going to need quite a bit of time, and I would say at least a month, if not two, to turn negative and tell us that a bear market is imminent, or that the market will bounce ferociously from certain levels that we've identified and go and make new highs. We don't know which one yet, but all we know is that those support levels are nearly bound to trade, because the liquidation that is going on in short volatility trades and risk parity is in the order of hundreds of billions of dollars, and therefore you do not stand in the way of that, but you take advantage of it when it gets to extremes. SPY, IEF, bing, and now we come back. This is, as you can see, still very much a bull market. There is absolutely nothing indicating that this is the absolute top. Could it be the absolute top? Yes, it could be, but what are the odds of that? It's unlikely that it is the absolute top. What it is likely is that it will come slowly down to test the next support line. That is still an indication of a long-term equity bull market and a long-term bond bear market. It's just that now equities got to very stretched valuations, and we can look forward to a period of normal two-way trading with a downside bias, simply because equities really got very far ahead of themselves. We always look for confirmation of our technical views from the fundamentals. I told you a couple of weeks ago that this chart was just silly. It was just stupid. And the market has duly retraced and come to its senses. When markets come to their senses, if they are just normal retracements within bull markets, they tend to retrace to the nearest, or say one lower, Blue Angel. So in this case, the time 17 Blue Angel, which is 2650-ish, let's call it. But if it's a big fourth wave retracement like here, they tend to always come to the 15 times Blue Angel, because that is what the long-term averages for forward earnings are, around the 15 times forward earnings. That is a long way below here, and we do not expect the market to come here with any speed. Around the 2300 or just above, maybe in a few weeks time it'll be 2400. We do not expect that to be a quick move. Can we get there? Yes, but that to us is going to be the absolute worst that this market can do, even if people need to do hundreds of billions in risk parity. That is where the true support will be from a fundamental point of view. So just that you know what we are looking at. We are looking at for something to come into the 2600s and then go back up, and then maybe come slowly down while these catch up. And the slope of this flattens out over the course of the weeks, and at some stage over the next 2 or 3 months we would definitely expect the market to go back up and retest at least the 18 times Blue Angel. This is a chart of SPY over DBC, which is commodities. To us, this is now beginning to be very important. If a market which has been so bullish and has gone up so much as equities have cannot take out a topping formation against DBC, and on Friday closed below the 50 and the 200-day moving average, that to us is a signal to shift allocations away from equities and into commodities. Now, could this be an early indicator of some bear market in equities to come? Absolutely, but that is not what's important here. What's important is the relative performance of commodities, even though they dumped on Friday, was better than the stock market, because the stock market dumped more. To us, that is an indication that long-term portfolios need to start shifting money out of equities and into commodities now. And this is SPY over gold, IAU, which is basically gold. Not quite the same picture as the commodities. This is much less bullish for gold or bearish for equities, then the commodities. But what is interesting is that um, from the period in November of 2016, when Trump was elected, till now, the relative move between equities and gold has been, although volatile, actually minimal, which to us again indicates that we have to start shifting some of our equity allocation, probably 2 or 3%, out of equities and into gold. It's beginning to make more and more sense. We have given it much more time, and it's just gone nowhere. Of course, since Trump's election, it's gone quite a bit, but the fact that since basically the market fully discounted the Trump victory till now, the relative move is so small that allocating more to gold and by taking away from equities is not a bad idea. Your stop can be above these highs, so relatively very close. The moving averages are still positive, but it's time not only to allocate money to commodities, but also a little bit more to gold. A lot of people will be saying, okay, Nick, well, if risk parity is being unwound, if short volatility trades are being stopped out as part of risk parity, where are people going to put their money? And I would say that people are going to do what they always do. They're going to put money, right or wrong, in the short end of the curve. This is a chart of the 2-year. It is probably as oversold as markets can get. Either the slope of this downtrend is going to get much less, or we're going to have panic buys towards the 107 area. Either way, I know what people are going to do. They're going to put money in 3-month money, 6 months, 1 year, 2 years. The short end of the curve, I think, is going to have much less potential of going down than going up. So it's a good risk reward to put some money in the 2-year and hope for a nice squeeze back up to fill these levels around the 107.06. We think that that is eminently doable and will be just a normal retrace in that move. It's market psychology. That is where people are going to put their money and then decide over the course of time where best to reallocate it. So we are going to take some money away from equities, put it into commodities, a little bit, very little into gold, and the bulk into the 2-year note or an ETF such as SHY for the foreseeable future. And this is SHY, an ETF which basically invests in the short end of the curve between 1 and 3 years. It's done a beautiful reversal on Friday. We would have thought it has room to run, possibly all the way to 83.80 or something like that. It is now trading 83.50, which in SHY is a very, very, very big move. 5%. That is very nice. You can make a lot of money out of that. So where's the money going to go? It's going to go in SHY. We don't have much doubt about that. Let's look for our biases. We're still sellers of the bonds, but money will flow to cash. So SHY is your preferred instrument. That's where you want to be long and possibly short of the others, but certainly you will find that the yield curve steepens on the back of these moves. The first signs are definitely here. We are shifting some money, as we said, and here we have volatility. I showed you the levels. Those are very, very important levels. Do not go against volatility in the short term. NQ will probably be the opportunity when it gets to that moving average that I showed you. That will be the time to go in heavy on NQ, possibly against the S, and or half outright and half against the S, but we will tweet that when we get there. And VX again is the one to watch. Any close above 1980, do not be short of volatility by any stretch of the imagination. Very bad things will happen very quickly if we ever close above 1980. We still like the super cycle. This is probably going to be the opportunity to get in. As you know, because the alpha generate the gamma, sorry, the delta generated by all these contracts is of a different intensity. You will find that the high betas will get crushed, so EEM will get crushed, EU will get crushed, probably XLK will get crushed more than the average of the market, but that will be the opportunity to get long of them and profit in 3 to 6 months time. DX, as we've been saying, we are now no longer bearish. 126, 40, 50 is the level that we're looking for. We're hoping that it gets there, but after that 88 to 92 in DX should trade for a long time before DX actually shows more weakness later on in the year. We still love the butterfly. It will get there as a result of the super cycle. This will be your opportunity to either put it on or add to it. Thank you very much indeed, and tweet you on Monday.